This is an age of disruption, of profound revolutionary change.
What we're really asking ministers is to empower the ambassadors.
The only thing that you really push forth is the truth.
You don't see many women represented when it comes to the decisions as to how to handle the pandemic.
Hi, I'm Hannah Brenton. I'm a reporter at Politico, and thank you for joining this panel on Solvency II, the capital reforms for the insurance sector. Before we get started, just to welcome you both online and in the room, we have a few housekeeping rules. You can ask your questions through the swap card platform, and we'll be taking them as we go, so please put them in already. And you can find the instructions on the event website. If you're already on the platform, also feel free to chat with your fellow attendees and ask questions in the question box to the right of the screen if you're on the desktop, and below the live stream if you're viewing on mobile. If you're joining us in person, you can ask your questions via swap card by scanning the QR code on the screens. So please do send some questions in while we get going. So this panel looks into the capital rules that underpin the insurance sector. The European Commission first put a proposal on the table over a year ago that would free up some capital in the sector in exchange for putting its investment firepower to work. We'll be discussing the state of those reforms in Brussels, particularly on the extent of the capital relief and on the sustainability requirements. And we'll also check in on the health of the sector in light of the turmoil that we've seen on the banking side in recent weeks. So joining me in the room is Olaf Jones, Deputy Director General and Director of Economics and Finance at Insurance Europe, and Martin Landé, Director for Insurance Policy at the French Treasury Directorate in the Ministry for the Economy. And online we have Henrike Hahn, a German MEP for the Greens, who is a shadow rapporteur on this file as well. So just to get started, we've seen some pretty extraordinary events on the banking side in the last couple of weeks with the collapse of Silicon Valley Bank in the US and the associated turmoil after that, and then the merger between Credit Suisse and UBS. Part of the issues there is of rising interest rates. Is that also a risk on the insurance side? Should we be worried at all about the resilience of the insurance sector? Olaf?
No, I don't think you should have any specific worries about the insurance sector. I think that every time something happens in the world, there's an understandable question, how will that impact insurers and what role do they play in often actually helping with the issue? Now, whether that's the last financial crisis back in 2008, 2013, whether that's COVID, whether that's the impact of Ukraine, whether that's low interest rates for long term and low for long interest rates, and now indeed high inflation. I think each time the industry has shown that it can manage, it can adapt. Risk management is a fundamental part of the industry. For most industries, it's a side product which has to be minimized and avoided. For us, it's actually what we do, what we sell, what we give to customers. So we take risk, we aggregate that risk into portfolios, and in some cases, we put that back in the markets, but that is where that's our expertise. And Solvency II has helped really enforce and make sure that all companies are managing risk very well, as many have always done, and sets that bar very high across all of Europe. It also adds a huge amount of transparency and interaction with supervisors. So I think combined with the internal risk management, what Solvency II adds, interaction with supervisors and the transparency, I think that creates a very well-managed, disciplined industry.
One of the issues in Silicon Valley Bank was the portfolio of government bonds they were sitting on, and they had to sell them at a loss. Insurers are big investors in government bonds, so couldn't they have those risks lurking on the balance sheet as well?
They could have those risks, not lurking, because it's all very transparent. I mean, for example, the insurers report asset by asset to their supervisor, so they monitoring that internally. The supervisor is fully aware. EIOPA also gets those databases, so there can be very constant monitoring. So indeed, asset liability management is a key part of the insurance business model, and that's, the insurers put a lot of focus on that. Now, the difference is with the banks, there's a fundamental difference, is that banks basically have an unstable business model which does rely on confidence in an enormous way, and that's why the insurance guarantee scheme is so important for banks to help give that confidence. Now, the Silicon Valley Bank was a very specific bank with a very special situation, I think has been mentioned by a number of commentators. So that is not a business model which I think we see in banks, even in Europe, and certainly not in insurers. In addition to that, the supervisory system in America is different. I mean, insurers, by the way, banks have, I think, 3 explicit risks they have to take into account in their capital charge, in their Pillar 1, and then the interest rate risk is a Pillar 2 issue. Which was a bit optional, it seems, in the US in this particular case. In Europe, for banks, it's not everyone has to do it. In insurers, it's part of Pillar 1. In fact, we have 30 risks we have to cover in Pillar 1. So we have and that's why when we talk about Solvency II and how strong it is, and that we support a risk-based method, it's because it's very comprehensive and very sophisticated. But it needs some improvement, as we'll come and talk about in a moment.
Martin, do you agree with that? Are you concerned at all that there might be risks on the insurance side?
Well, I think that when we take a look back, insurance undertakings have shown their resilience in the COVID-19 crisis, in the aftermath of the war in Ukraine. They have maintained a high level of own funds. They are well capitalized at the French and European level. So it shows that overall, the Solvency II framework is well designed and managed to capture correctly the risks facing undertakings. Having said that, of course, there are ways to make it evolve to better take into account certain specificities, but on the whole, we clearly are not facing a revolution. Having said that, the increase in interest rates and in inflation is clearly a game changer for insurers. We saw in 2022 an economic paradigm shift, but to see it in a bright light, positive interest rates is a good thing for insurers. I mean, we know that negative interest rates were not sustainable over a long period for insurers. So it is a positive evolution that interest rates are back in positive territories. High inflation, increasing rates pose other challenges to insurers, but to us not at the scale of those that were faced through negative rates.
Okay. Henrike, you're sitting in Brussels. Part of the discussion on Solvency II was also about resilience and a resolution framework for insurers. Do you think that that's more pertinent now in light of what's been happening on the banking side?
Yes, of course. I mean, we observe the developments in a very careful way, but above all, let me say that given the current turbulences on the financial markets caused by the increase in interest rates, we should seriously consider whether we want to loosen capital requirements for the insurance sector. And after all, it was exactly the deviation of international standards by the previous Trump government, which led to a kind of looser regulatory overview of the Silicon Valley Bank and its eventual bankruptcy. And another important lesson learned specifically for the current solvency review is that the introduction of an enhanced proportionality regime should be risk-based. Only insurance undertakings that truly have a low risk profile should benefit from the new proportionality measures. And we shouldn't make the same mistakes here in Europe. And we should make sure that our insurance sector remains resilient via risk-based prudential regulation. And I also, of course, welcome that the Commission included some macroprudential powers focusing specifically on market-wide shocks, as well as liquidity risks that national supervisors can use in time of crisis. And it's crucial that we equip supervisors with these important instruments. And of course, nevertheless, we also need to be prepared for the worst case. Therefore, I very much welcome that the Commission proposed in parallel to the Solvency II review a recovery and resolution framework for insurance undertakings. And while the negotiations have already progressed quite considerably on this file in the Parliament, I would still like to make some general points. First of all, given what we have seen in the US in the past week, I think it's of utmost importance that we move as quickly as possible towards a harmonized framework for resolution and resolution financing in the EU. Of course, for the sake of completing the single market for insurance products, it is crucial that in the long term, we put in place a European-wide resolution fund that can provide the sufficient financing for resolving insurance companies. And furthermore, as we have seen in the US, we need to give consumers certainty over whether their deposits, or in our case, insurance policies, are covered through a guarantee system. And the current patchwork of insurance guarantee schemes in the EU is a major obstacle to the completion of the single market for insurance products. And we are falling European consumers by not providing them with adequate protection. And therefore, the Commission should come forward as soon as possible with a proposal on the harmonization of insurance guarantee schemes.
Olaf, the industry would have to pay for that, right? So would you welcome an insurance guarantee scheme?
No, we wouldn't welcome an initiative, a European-wide initiative on insurance guarantee schemes. I think there are a number of guarantee schemes in different countries, and often that's tailored to their particular needs and products and landscape. And generally those seem to be working well. So we think that the guarantee scheme should remain a national prerogative. And I think it's worth bearing in mind that when Solvency II was designed, it was designed specifically higher than international frameworks. So in banking, there's a discussion of should we increase Europe to what is perceived as the international benchmarks, and criticism of America being, in this particular case, certainly lower than those Basel benchmarks. Whereas in insurance, there is no formal international standard. There is one under discussion called the ICS, but in that case, what we have in Solvency II in Europe is way higher and way more volatile than this sort of under discussion international standard. And it's worth noting that some supervisors, and this is not just the industry, but supervisors around the world have said this international standard being discussed is way too volatile and too excessive to allow their companies to invest and offer their customers the type of products they need. So what we are looking for here is in no way weakening the European system. It's just recognizing that in certain respects, we've created a system which is too volatile and too excessive, particularly for long-term products, and that affects long-term investments. And we need to make some tweaks which are justified on a technical and risk point of view, and will release a certain amount of capital, would reduce volatility, but would leave customers incredibly well protected, and Solvency II would remain an absolute gold standard worldwide.
Marta, because there's this debate that we've been having all along about resilience versus capital release, right? So because you were involved in a lot of the council positions, so how did you weigh that up in council?
Let me first go back to the point raised by Enrique on the resolution recovery directive, because we totally agree on the fact that this is a key piece of the puzzle. This is key for financial stability, this is key for policyholders' protection, and this is also key for the protection of public finance. So we think that we should move forward on IRRD, in Insurance Resolution and Recovery Directive. We worked hard during the French presidency at the Council. We worked hard under the Czech presidency, and the compromise was found. So we are eager to initiate the trilogue with the Parliament on this issue, because Enrique is totally right on this. We have to move forward. Then on the harmonization of insurance guarantee scheme, on the French side, we have some tenderness for the idea. I think that we saw during our discussions that it was too high a step to be taken right now, but we clearly have to bear that in mind. There is things on the financing of resolution in the proposed compromise, so we think that we can build on these achievements to move forward on this. And so to go back, sorry for that, to go back on your question on resilience and capital charges, we think that the Commission dealt with the equilibrium in terms of capital charges in a clever manner, i.e., they try to alleviate a bit the charge, but maintaining a high level of prudence, for the protection of policyholders, for having sufficient buffers for insurers to weather economic shocks. And so that's why we, at the Council during the French presidency, we built on these proposals, very, very interesting. We think that, of course, we have to make insurers able to play fully their role in terms of long-term financiers of the European economy. This is key. We have 3 trillion euros in terms of equity corporate bonds in the hands of European insurers. They are the elephant in the room in terms of recovery and of financing the economy. We have to use this more adequately, and we think there is room for improvement in this regard. And on this, the French Treasury made the case for a specific treatment for equity detained over a long period of time. This is the so-called long-term equity investment portfolio. We think it's useful. As I speak, it's not used by insurers because it's too complex. The conditions, the strings attached are too high, and so we are working currently with our colleagues at the Council, with the Commission, also with the European Parliament, to find the ways and means to streamline the conditions and to free and to help insurers use it in a proper manner, and then it will free up capitals for the financing of the economy and for financing the Green Deal as well.
Okay, just sticking with your point, coming back to long-term equity in a bit, but on the resolution side, you mentioned the financing. Henrika talked about an EU-wide resolution fund, but the financing is controversial in Council, isn't it? What was kind of the position on that side?
Well, I can only speak of the compromise of the Council. There is an article on this, and so there was a compromise on this. So, we have a...
But there's no upfront financing, right, to finance a resolution?
Well, on that, as it is new for many member states, the thing is that we have at national level to do our homeworks. In France, we have in place insurance guarantee schemes since long, but we know that it's not the case in other countries. So it's a first step, but a very useful first step.
Olaf, you wanted to come back in?
Well, maybe on a number of points, I'll try to be very quick. I think, first of all, on recovery and resolution, we're in favor of some basic harmonization there. I think it's a question of how much is really needed. It may be overlooked that Solvency II already has significant aspects of both recovery and recovery in there. For example, as soon as a company falls below the very high SCR requirement, which is way above the
Solvency capital ratio.
Solvency capital requirement, which is about up to nearly 3 times as larger than the real minimum, at that point they immediately have to have a recovery plan. So there's already a requirement for an early recovery plan. The discussion is which company should have an early recovery plan. In other words, when there's even no indication of any shortfall in capital at all. And I think that's where the particular debate is there. And then the second debate is indeed about whether or not you need any financing arrangements in place in advance, whether you can leave that on a national basis. We think, again, there should be national flexibility. We think there is a danger if you tie up a lot of capital in something where, if you look at the historical need for it and the expected need going forward, it really is very limited indeed in terms of the type of problems that insurers have had, and even less often has that led to customers actually losing money.
Henrika, would you like to see more financing up front? You mentioned like a resolution fund. How would that work?
And let me get back a little to what was just discussed on the capital requirements. Let me add that the current solvency framework has proven to be very effective, and any changes to the Solvency II rules, and specifically the capital requirements, should remain risk-based. This is a very clear statement we have, and it's important that we refrain from excessive excessive capital relief. And I agree with the idea that some capital relief could be useful to ensure that insurers as long-term investors in the economy can support the financing of the green transition, especially in light of the energy crisis, as well as the post-pandemic economic recovery. And let me ask you a short question to Olaf, because since we all agree that capital relief is at least to some extent needed to finance the green transition of the economy, I would be curious to know from you, so what rules could policymakers put in place to ensure that capital relief goes towards long-term investments and not towards shareholder payouts? So I believe it would be prudent to put some stricter capital requirements in place when it comes to climate risk. So let me introduce that point in that discussion at that point. And we all know, for instance, that investments in fossil fuels by definition have to become worthless in a few years as we are transitioning to a net zero economy. And therefore, it only makes sense that such investments should be treated as investments in the riskier asset class, as they're bound to become stranded assets. And the recent IOPA discussion paper has highlighted quite clearly that such a prudential treatment is both sensible and feasible. And with regard to the discussion you had before, I'm very glad that we share a lot of point of views from the Parliament's perspective with what Martin just said. So thanks.
Well, if I can put that to you, because it's a good question, but Henrika should be moderating. But it's, how do you know it with the amount of capital relief that is passed on to insurers that it won't just be returned in dividends, or how do you know it's going to be put to work?
Well, I think it's very difficult to legislate for that because you can create all sorts of other problems if you do that. I think if, however, you consider the basic issue here is about whether or not insurers can make use of their capital. They already hold excess capital, and they're not immediately giving it all away back to shareholders. What insurers want to do, like almost every business, they want to find productive uses for their capital. And it's when they cannot find productive uses because the capital requirements are too high, that's when the pressure to give it back comes. So by achieving the right amount of capital, which would allow insurers to write the long-term products, which many customers need and want, which also are the reason why we can invest long-term, because without long-term liabilities, we don't have the ability or the need to invest long-term, and it gives us that stability role in the economy. So what we want is an outcome which sets not too high capital, not too low capital, but the right capital. Indeed, we want to make it risk-based.
What is too high and what's too low?
Well, the capital, well, if we try not to get into technical details, but there are elements of the balance sheet which are set too high. I mean, one that is talked about is called the risk margin. That has a direct impact on the available capital that can and should be reduced. The Commission has recognized that. EIOPA has recognized that. What we need to do, though, is a bigger reduction than the Commission is putting forward is justified.
On the risk margin specifically?
Specifically on the risk margin. That's one example. There's a few others. I think the equity capital charge is another one where I think it's fully justified. And I think here it's a question of really understanding the nature of risks, because what we mustn't fall into is a sort of dogma of this must be the way you manage it or measure it. The question is, what is the real risk? Right now, the assumption for the equity capital charge is that if there was a market fall, the equity portfolio could fall by 50%. Now, that's not necessarily unreasonable as one of the worst case crashes type example. But the assumption that Solvency II has built in is that the insurer would immediately sell their entire equity portfolio and realize that full loss immediately, which of course they would never do. And they don't need to do because of the nature of their business model. They're not traders. They're using this to back long-term liabilities. Some of those are even non-life liabilities, particularly also savings products. And that means that the way in which the capital charge is measured is simply not correct. And that's why the introduction of this long-term equity capital charge, which is 22% instead of 50%, is a much better representation of the long-term underperformance of equity, which is still a very extreme, because over long-term equity have always given very positive returns. We're going to take an extreme example where equities over the long term produce a negative 22%. So it's also a matter of getting the risk measurement right. It's not a matter of just lowering the bar, increasing the bar. So if we get the measurement right, the result will be a release in this case, but a justified one.
Marta, do you agree with that you need to tweak those parameters to kind of get insurers investing more long term?
I think that, as I said, we need to be balanced. we think that there are parameters that could be changed, and on the risk margin, we concur with the fact that it could be lowered. On long-term equity investment regarding equity risks, we think that it's a way to alleviate the charge and also to be sure that this alleviation goes to the financing of the economy, because it goes to financing firms' equity. So you are sure that it's not given away through dividends or things like that. And I think that it is also important to recall that we evolve in a competitive international environment. That is why at the Council we introduced the notion in the recital of the directive of level playing field at the international level, because we cannot delineate the prudential rules from an ivory tower. We have to, to bear in mind the international environment. Olaf mentioned the international capital standard discussed at the international level. We know that in the UK, reflections are ongoing on strong alleviations of the capital charges. So it's not about racing to the bottom. It's just about having in mind this context and being sure that we find the right balance between prudence and sufficient leeway given to insurers to finance our economy.
There has been a big debate in the UK, though, between the regulators and the industry about the extent of that capital relief. Does that apply in the EU as well? Because we have seen IOPA warning about the extent of some of the capital relief on the table.
Well, honestly, we look, of course, with interest to the discussions ongoing in the UK, but we have our own fora and our specificities, and so it's not something that we want to copy or to. We have to be cautious also on that.
Okay, Henrika, in the European Parliament, there is still a big debate about what extent of capital relief should be on offer. Can you tell us a little bit about where the tensions are at the moment within that debate?
So we are still currently negotiating on this, and
oh, we've lost the audio for a second. Are you on mute, Henrika? Can you hear me? Okay, maybe we will. Oh no. Okay, unfortunately, we've lost you, Henrika. We'll just try 1 second to get you back. Okay, we'll come back to you in a second. But on the sustainability side of things as well, there has been also a big debate about how much to include in the text itself, particularly in Parliament. Martin, how did you decide that in Council, or what's like an appropriate amount of kind of climate checks to have in there?
Well, I won't surprise anyone in saying that climate change is, of course, the most tremendous challenge that insurers are facing and has faced for many years. So we know that it implies dramatic impacts both on the asset side of insurers and on the liability side. And it's important to use these two legs in terms of how you answer, how you tackle this issue. Solvency II is first and foremost a prudential regulation dedicated to a specific sector. Climate change is a transsectoral issue. So the first thing is that the transsectoral issues should be dealt with in transsectoral texts. That's the ambition of the green package with the SFDR, Sustainable Finance Disclosure Regulation, with CSRD, the Corporate Sustainability Reporting Directive, the European Taxonomy. So all about reporting to ensure that the information is given to investors on what is behind and what is the impact on sustainability. Of course, on Solvency II, we also have to take into account these issues, and that's what we tried to do in the compromise. That's what we tried to do through the better management of the climate risks in the own risk assessments of insurers, the so-called ORSA, very poetic, And we think that it's a useful way so that insurers manage to put in place the adequate governance of these risks, even at the highest level of the undertaking. We also think that things can be done in terms of climate stress testing. We've done that, we did that with ACPR on the banking and insurance sectors a year ago, and we think that it would be good that this kind of stress testing be harmonized at the European level, so that you have a level playing field in that front. And then, more specifically on the prudential aspect, well, there have been discussions on brown penalizing factor, green supporting factor, very interesting discussions. On that, I think that we asked EIOPA, along with EBA, ESMA, to reflect on how these ESG factors should or could be more stringent or not in the prudential part of Solvency II regarding insurance. And so we'll see how they analyze this, what kind of proposals they make, what kind of evidence they can gather, and we'll see.
I think we've got Henrika back now, I think.
Yes, I hope it's working now.
So yeah, if I could come back to... If I could come back to you on the question on the capital relief in Parliament, but also based on what Martin has just been saying, that there are some, already a lot of rules dealing with sustainability, the taxonomy, SFDR. So why do we need the sustainability part of this in Solvency II as well?
Yes, as I was trying to say before, there's a large political majority in the European Parliament supporting that capital requirements should remain risk-based, and we really know that sustainability will have to play an important role in all that. And I think because Martin was talking about it, about the overlap with horizontal climate change legislation, we think that the Commission proposal is a step in the right direction when it comes to incorporating sustainability provisions into Solvency II. But it's, of course, not enough to enable insurers to align their business model with the net zero economy. Furthermore, specifically introducing transition plans in Solvency II would not create any overlap with existing legislation. And it's true that the Corporate Sustainability Reporting Directive doesn't contain a requirement to disclose transition plans. However, now it's our task for the Solvency II file to spell out the requirement for insurers to actually develop transition plans with clear and measurable targets that align their business model with the climate neutrality objective enshrined in the EU climate law. And this is the crucial distinction between the CSRD, or the Corporate Sustainability Due Diligence, which are horizontal laws, and the Solvency II Directive, which is a sector-specific lex specialis. And the insurance sector is probably one of the most important industries to put such plans in place, as they're both investors and risk managers of our European economy. And when we talk in a more general way about sustainability, let's mention that in 2022 alone, losses from climate change related natural catastrophes covered by the insurance sector amounted to up to 132 billion euro, which is 57% above the 21st century average. And at the same time, insurers continue to invest in fossil fuels, and many haven't committed to phasing out their underwriting of fossil fuel activities in line with an orderly transition. And in the long term, this increases the risk of stranded assets as investments and underwriting of fossil fuel assets become worthless, and the more the economy decarbonizes. So, of course, it's in our hand now to minimize the impact of fossil fuels on our economy and on the stability of the financial system by encouraging insurers to seriously move towards a net zero economy. So there are lots of more aspects about that, but I think we have time constraints.
Okay, Olaf, I mean, so insurers aren't doing enough. You need something stricter to get you to transition to net zero.
No, I don't think we do. There is an enormous amount of action already being taken by the insurance industry. And I think our industry was one of the first to highlight the concerns, because we saw, obviously, many years ago, the increasing effect on extreme weather events that we obviously do cover. What we're seeing is a gradual increase, and I think the expectations are that will continue. Now, although that obviously is a risk we have to manage, and we have to make sure we're capturing the extreme risks in terms of the capital charges, and that's why we support the proposals from the Council to more regularly check those risks to make sure that the capital charges are kept up to date. But we can price every year, so the risk in terms of solvency is not so great. The real issue is on society. Can society cope with what's happening? And is society able to buy the insurance and adapt quickly enough? So what we need is, for example, transition plans from everyone. Because if everyone has to do transition plans, then everyone starts adapting. They start creating green projects, which we can invest in. So we can then move our investment portfolios and we can adapt our underwriting appropriately. So we really support the idea of a cross-sectorial approach to transition plans, and that is in the Corporate Sustainability Due Diligence Directive and in one of the articles. And
it's a bit chicken and egg, though, isn't it? If the insurance sector starts asking for them, then they might get more transition plans.
Well, we're asking for them in the Due Diligence Directive and saying, yes, we absolutely support that element for everyone. I think that would cover something like 11,000, 12,000 of the largest companies in Europe. Now, we would be part of that. We're fully willing to do that. What we think is less logical is to do that within a sectorial regulation. If it is done within Solvency II, then care has to be taken to avoid overlaps, inconsistencies, which unfortunately we have seen in other regulation. We've seen multiple elements where consumer disclosures covered in 3 different directives, creating all sorts of costs and problems for consumers and also for insurers. So we want to avoid duplications, but we're actually fully supportive of transition plans. And we're also supportive of the other elements that Martin has mentioned in terms of the further detail that will be put into Solvency II under the review.
Okay, we're coming towards the end of the panel, but Henrike, it could duplicate other legislations. Is it a red line for the Greens in the negotiations, having transition plans included in Solvency II?
Well, let's say that way. The Commission proposal is a step in the right direction when it comes to incorporating sustainability provisions into Solvency II, but it's not enough to enable insurers to align their business model with a net zero economy. So furthermore, specifically introducing transition plans in Solvency II would not create any overlap with existing legislation. And it's true that the Corporate Sustainability Reporting Directive doesn't contain a requirement to disclose transition plans. However, now it's our task in Brussels for the Solvency II file to spell out the requirement for insurers to actually develop transition plans with clear and measurable targets that align their business model with the climate neutrality objective enshrined in the EU climate law. So this is the crucial distinction between the CSRD or the corporate sustainability due diligence, as I said before. So yes, this is the green point of view or the Parliament's direction.
That sounds like a red line. But can I ask just one final thing on the debate about capital in Parliament as well? Can you explain where you think it sits at the moment, where the tensions are? Is it around the volatility adjustment? Is it the extent? Because IOPA criticised the amount of capital relief on the table in the Parliament. Are you, at the moment, negotiating reining that back in?
Sorry that I have some sound problems, so I couldn't understand the question at this moment.
Okay, all right. I think we've had some technical issues on this panel, but I think we got the majority are debating the capital requirements in Parliament at the same time. So thank you so much for everyone for taking part in this panel. We will have a quick 5-minute break, and then Basel III and the Banking Union is next. But if you could stay seated while the speakers switch. Thank you so much for taking part. Thank you.